You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Exchange-traded funds, or ETFs, are subject to risks including loss of principal. Sector ETF products are also subject to sector risks and non-diversification risks, which may result in greater price fluctuations than the overall stock market. ETFs are subject to risks similar to those of stocks. Diversification does not eliminate the risk of experiencing investment losses. ETFs are considered to have continuous liquidity because they allow for an individual to trade throughout the day. Ordinary brokerage commissions apply when trading shares of an ETF. ETFs are considered transparent because their portfolio holdings are disclosed daily. Alps Distributors, Inc., a registered broker-dealer, is distributor for the Select Sector SPDR Trust.
A fearless stock market is a dangerous place to invest. So how does one prepare for higher market volatility? And furthermore, how can a person thrive during turbulent bond and equity markets? Here to talk with us about that is Russell Rhoads. He's a CFA and instructor at the Options Institute at the Chicago Board Options Exchange. He's also author of Option Spread Trading, a comprehensive guide to strategies and tactics that was released in January of 2011. It's available at Amazon.com. Go get a copy. Russell, great to have you with us. Welcome to the Index Investing Show.
Well, I'm happy to be here. We're going to be talking about one of my favorite topics, VIX.
Well, we continue to be in a lull period with the U.S. Stock market volatility as measured by the SIBO VIX still pretty low and depressed. So give us some historical points of reference. How does the VIX look today, and how does it measure up compared to history?
Well, you know, a lot of the comments I get from people, I go around the country and probably do about 200 speeches a year, mostly on VIX. And I get a lot of questions about is VIX broken? Is it doing what it's supposed to do? And I think it's because everybody has kind of a short memory. Since 2008, VIX has been definitely elevated relative to where it had been historically. But before 2008, you know, VIX in the mid-teens was kind of the norm. And if you look at what VIX has done for the first 8 months or so of 2013, it looks an awful lot like what the first 8 months of 2007 looked like. But by the end of 2007, we had a couple of instances where VIX ran up to 30. So VIX might be in a lull right now, but the possibility for a spike definitely exists.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Russell Rhoads. He's an instructor at the Options Institute at the SIBO. He's also author of Option Spread Trading, a comprehensive guide to strategies and tactics. Now, many investors and traders are confused by why VIX ETFs and VIX ETNs are not able to closely track the VIX. Could call or put options to make bullish or bearish trades on the VIX possibly be a better alternative?
Well, you know, I love the questions that start out with an "it depends," and it really does depends on what your expectations are. Just to address that first statement, and that's another one of those things that really does keep me employed, is clearing up the difference between the VIX ETNs and specifically VXX, which does about 90+% of the VIX ETN volume. The VXX actually focuses in on a volatility strategy, and the strategy involves owning a weighting of the two front-month futures contracts. At this point, that would be the September and October VIX futures contracts. And it rebalances that weighting every day. More often than not, the near month is at a discount to the farther month, so you have a cheaper future being sold and a more expensive future being bought, and that puts a headwind up against VXX's performance. Now, VXX, in its own right, either a call option on VXX or an outright long position in VXX, will do, and I steal this statement from a really smart guy in our research department, it does what you want it to do when you want it to do it. And that means when we get a spike in VIX, you tend to get a bigger move from the front month future, and you get kind of a double bonus, higher VIX and a market structure that benefits VXX. So, a long position on VXX is not something that you want to hold for the long term because of a constant deterioration of the value of VXX, but it's definitely a good short-term vehicle if you expect a near-term spike in volatility. And the same thing with buying an index call option on VIX. The same thing. You get a spike in VIX, and you can benefit from that as well. But it kind of depends on the nature of the spike that you might see.
Russell Rhoads, CFA and instructor at the Options Institute at the SIBO, joining us. Even though the 10-year yield on U.S. Treasuries has surged, investors that want high income aren't necessarily going to get it from a 3% yielding Treasury. We're not even at 3%, but we're almost there. No. So what about selling covered calls on an ETF portfolio? Is this still a viable strategy?
Selling, covered calls, and I'll use the SPY, the most common ETF out there, as an example. Selling a call option against the SPDR is it's very similar to an index that we have here at the CBOE called the Buy Right Index, which is quoted under the symbol BXM. And the Buy Right Index replicates a strategy where once a month an investor would sell just out-of-the-money call option against a long S&P 500 portfolio. You could be long the SPY and sell a slightly out-of-the-money or the next strike-up call option. Over the long term, that strategy has, on an absolute and risk-adjusted basis, outperformed buy and hold total return for the S&P 500. We've seen a lot of interest over the past 2 or 3 years in that strategy, partially because of market outperformance, but also for the reason that you cite, which is people seeking yield. We get a lot of investors that were long-term investors that felt like they were going to be able to get yield from bonds when they reached retirement. They're not seeing that, and covered calls are one of the alternatives that they seem to be looking at.
Here's, I think, too, Russell, one of the hidden beauties of the covered call strategy is you're still able to collect, and correct me if I'm wrong, the dividends on the underlying security. Is that true or false?
That is true as long as, and I'm glad you brought this up, that is true as long as you are not assigned on your call option early. And when you're short a call option, you always do have the possibility of the underlying being called away from you early. And if that were to occur, you would actually sell your ETF, let's say the SPDR, but you also would not receive the dividend. The OIC materials on early assignment actually want investors to be aware that you have a higher likelihood around a dividend of that possibly happening. But as long as the option is out of the money, the short call option is out of the money, you probably are not going to have your underlying called away from you, and you still will, as you stated, receive the dividend.
Russell Rhoads joining us. You're listening to the Index Investing Show. Options instructor at the Options Institute. He's also author of Option Spread Trading, a comprehensive guide to strategies and tactics. It's at Amazon.com. Go pick up a copy. So as the SIBO instructor you are, I'm going to try my best to snag you with a trick question. And here it is. What happens if an investor sells an out-of-the-money covered call that goes in the money, but on the day of expiration closes out of the money? Do they still get to keep their underlying ETF?
If they are not assigned on the obligation that goes along with that short call option, yes, they will continue to own the underlying stock or ETF. And in fact, sometimes you might have a call option that is slightly in the money, let's say like a penny or two, and somebody that holds that call option did not hold the call option with the intent of buying the underlying, and they may actually choose not to exercise the call option. So there are actually times where an option might be slightly in the money. The fees associated with going through the exercise process make it undesirable, and holder chooses not to exercise their option. So it can go both ways.
In the past, we know that options have typically expired. We always remember the third Friday of every month, but now we've got weekly options, and I know you're working on a new book that is going to be coming out in January. Talk about that.
Sure. Weeklies came out on stocks and exchange-traded funds back in 2010. The CBOE actually had weeklies on the SPX starting in 2005. They didn't get a lot of attention until more weeklies were available. Now we've got options that expire every Friday on just about 200 underlying indexes, exchange-traded funds, and stocks. And the short-term time decay nature of options when you're approaching expiration, it ends up resulting in some strategies that you can trade pretty frequently that you used to be able to only trade once a month. So that that led to actually a full book full of material about different short-term trading strategies that work well with short-term options.
Well, we look forward to having you back and talking more about that. Again, you just heard from Russell Rhoads, instructor at the Options Institute. This is the Index Investing Show. I'll be right back.
The Index Investing Show with DeLegge.